Hello and welcome to today's discussion with Rubini Global Economics. I am Christian Menegatti, Head of Global Economic Research, and today we have with us Arnab, our Head of Market Strategy and Research.
Pleasure to be here.
Good to have you. After all, you're based in New York and London, so
I try to go back and forth.
Exactly. But good to have you here this week. And I thought that maybe this is the week in which we published our quarterly outlook, and I thought that maybe we could think about a little bit about some of the global risks that are out there and how to play those or hedge for those in the markets, right? So four of the main risks that we have, some of the main risks that we have highlighted during our outlook call with our clients and within our outlook are oil prices that might be rising, courtesy of a fear premium or situation in the Middle East that might escalate, right? Although we don't think necessarily there will be a conflict at the end of the day. Possibly macroeconomic data surprising on the downside in the United States and in the Eurozone, right? And again, risks of Eurozone again becoming a significant downside both in the short term but also in the long term, given that solvency issues have not gone away with long-term refinancing operations. And then this Chinese slowdown that again might play out in a slow grind fashion, nevertheless. Could be significant negative contribution for global growth and for confidence in the near term, but also going forward as they rebalance their growth model. So, where do we start?
I think all very easy issues to grapple with.
Right.
So let's take them all one by one, right? So maybe if we start with the U.S., because it's my impression that clients or market participants are much less focused, for better or for worse, on the Eurozone, right? It's receded to a back burner issue.
Yeah, headlines are not all about.
Spain's an issue,
right.
But the pain in Spain is becoming plain, right? So, well, in the United States, the big thing that seems to have happened that's added further fuel to this liquidity-inspired rally is the interpretation of comments by Ben Bernanke that seemed to put the dissidents, down one notch, and put more money on the table, right? And I think it's quite interesting that the market initially had responded quite strongly to this, quite favorably, and then is now pulling back a little bit. And maybe there's a little bit of a reassessment going on. What does Ben Bernanke know that the rest of us don't know, that the hawks and the dissidents don't know? As you were intimating, I don't think there's anything new here under the sun. It's just a question of the emphasis and the weight.
Yeah, absolutely, and I think that we've always thought that inflation was less of a concern for at least some inside the FOMC, right? Depending of where people feel like they are with respect to capacity in the economy, right? And we clearly think that we are not close to capacity. Seems like Ben Bernanke seems to be thinking the same way. So inflation less of a concern, and perhaps housing and possibly income generation and a forthcoming fiscal drag or maybe slowdown because of high oil prices seem to be some more growth kind of in nature, right? Growth issues in nature seem to be more front and center, at least for Bernanke, and given his comments the other day. So not sure that should be a surprise. In some sense, it wasn't for us, but markets did react to those comments, right? Because I think QE3 was taken off the table a little bit after the better data in Q4 and the beginning of the year, right? Now that seems to be coming back, even if the economy has not yet, surprised on the downside necessarily, right? Some mixed data at the beginning of the year.
Yeah. I think in a way, Bernanke is signaling that the Fed will still behave in a kind of path-dependent, data-dependent manner, which has been the message all along. And I guess the additional angle here is that I don't know if it's actually information, but the additional judgment or insight into the judgment is that there is this risk that we're still caught in this kind of groundhog pattern where one kind of shock or another, among those that you mentioned, oil prices, Middle East, saber rattling, Eurozone, or just the still heavily laden balance sheets, national balance sheet in this country, including the coming fiscal drag, is going to constrain growth, right? On the fiscal side, I mean, either it's going to be a politically determined, something that's worked out between the president, whether he's a lame duck or not, and the lame duck session of Congress, or if they can't succeed, it might be determined by sequestration, which could be quite severe, at least in many people's minds, right? So we may or may not get there, but there will be something of a fiscal drag, which will be kind of in a way the wrong way we should do it. We should have more stimulus now, and backloaded structural fiscal reform, deal with the entitlement problems and everything else, rather than front load the fiscal adjustment and not worry too much yet about the big problem of 700% of GDP and unfunded liabilities.
Yeah,
right?
absolutely. I think that you know, at the end of the day, growth is also an important variable to that sustainability, right? So going back, revenues in the United States are highly cyclical. So going back to stronger growth, at least stronger than what we have seen on average in the last couple of years, would be important to improve also revenue collection, right? So that could heal a lot of wounds in terms of fiscal imbalances. But talking about imbalances, right? Maybe it'd be nice to switch the gear and look at a large emerging market, which is sort of the mirror of the U.S. in terms of current accounts and consumption shares of GDP, right? So maybe we can talk a little bit about China and how we feel like their growth model is broken and how that rebalancing might take place over time. Maybe not just yet, but over time.
Right.
Right?
I mean, I guess one of the you know, we've been discussing among ourselves and with our clients for quite some time that the bigger picture that Adam Wolf, our China economist, has laid out very clearly, Nouriel's also laid out, and I think all of us at different times have laid out in different ways. The growth model is broken, and what lies ahead is a much slower trend growth rate for China, right? It's not just about whether the number for this year is going to be 8
right.
plus whatever is the consensus, or 7.5 that's in the official plan that the premier has been drawing attention to, or the 7 and change that we're forecasting. The bigger picture here is that as the Chinese go from an export-led through an investment-led to a consumption-led growth model, there's going to be a substantial slowdown in trend growth in China from the low double digits
right.
through the mid to high single digits to the low to mid single digits, which is absolutely natural for a country that has been catching up so fast for so long. There's this big still danger that along the way, because there's an investment bubble now in China, as there has been for some time, that there'll be a crash landing along the way.
Right, absolutely. And you can switch off investment quite fast. You cannot switch on consumption to make up for the lack of investment as fast, right? So
particularly when the household share of income is so low,
yeah, so
right?
low.
So,
absolutely.
and of course, changing that is a generational change in the case of China, because what you have to do is really find a politically stabilizing way to have the people of the People's Republic share more completely in the spoils of growth. Right? So,
you know, so sometimes people push back on all this and they tell us, you know, but they owe that to themselves at the end of the day, right? So they can kick this can down the road much further. They can continue to fuel this investment-led growth model and go on like this for a number of years, right? So my concern personally is that, you know, if they continue to do this at the end of the day, they're going to have a much larger problem inside their banking sector, right? A much larger hole, and of course they will never be able to deepen their financial sector and open up their capital account to the extent that can significantly improve the consumption smoothing process and therefore raise the share of consumption to GDP, right? So
yeah, and also have market-determined prices for the allocation of resources and capital, right? So I think people do make this argument, and there's a lot in it, not least because the Chinese mandarins, if you like, have been extraordinarily successful at managing the growth process until now and avoiding the pitfalls of bad Western advice or, you know, market-determined crises and so on. But I would say, you know, there are plenty of examples of countries that have borrowed a lot of money from the future of other countries and from their own future, and all have ended up in a very severe problem when they've had an investment bubble, right? The Chinese variant of the Asian model of growth is just that. It's a variant,
yeah,
right?
Absolutely.
It's state-directed in every sense, right? In the Chinese case, maybe more state-directed at the margin than some other countries, but basically the state has picked winners from among itself, from within itself, in various industries and various sectors, and allocated the resources and the capital to ensure that those are the winners. And of course that's worked very well during the vendor-financed export boom, right? Now that that's come to an end, we've gone through a splurge of investment, again picking winners, and some of those are turning out to be losers in some sense, right? So eventually, this model will face, at a minimum, this new variant of the model, investment-led, will face headwinds. Even if it doesn't come crashing down of its own weight, it will affect the rate of growth, not just the rate of transfer of income and resources from the state to the people, back to the people from which the state got those resources in the first place. It will affect the growth rate of those resources that the people can enjoy. So consumption is going to be the growth driver, but it's going to be a difficult transition.
And in the meantime, growth is going to be significantly
is going to be, at best, is going to be significantly slower. And we're going to have political turbulence in this, right? This is supposed to be a very smooth political transition year, and it's not.
We're seeing this already, absolutely. So in the short term, how do we play all this? How do investors play all this?
Well, I guess in the very, tactically in the very short term, it seems that money still makes the world go round, and, you know, quote unquote, the Bernanke opens his mouth and the spigots start to flow, and so there's more fuel in the fire, so it all goes up. So that probably has some room to run, but the headwinds are increasingly apparent, and there are constraints even in that strategy, right? So even if the saber rattling in the Middle East doesn't lead to anything, as you know, as you were saying, that's our view of it, that the saber rattling will continue. We won't have a conflict just yet, if at all. Even so, weakening the dollar and you know, by turning on the spigots, even just verbally, would tend to raise the price of commodities relative to where they would otherwise have been, including energy. So that's gonna be a constraint on consumption, which is eventually going to come through. In the Eurozone, we're already starting to see the contradictions of this approach, of, you know, putting more liquidity into a solvency problem. You know, that's turning into a bit of pressure between in the politics between Germany and her client states. We can see that in the kind of the revision of the fiscal targets. That's going to be a bit of an issue for Spain. We're going to see some, you know, not great, if not appalling, growth numbers out of the Eurozone. We're not going to be in a crisis anytime soon, it doesn't look like, but there are going to be headwinds. People are going to eventually feel, or at least fear, that the Eurozone will come back to the front burner, complete with its existential crisis. And we'll have either the Chinese slowdown or hard landing, crash landing, whatever it's going to be ahead of us, right? So tactically bullish, strategically, let's say, concerned, worried even.
Yeah, already the sort of concerns around Spain and Italy, in particular Spain meeting fiscal targets, and Italy now facing a test as far as labor market reforms are concerned. Already those constraints are already showing up, and even in the spreads, they're a little bit moving, you know, starting to move a little bit up. Well, it was nice to talk to you as always. Thanks a lot for sharing your thoughts. Thanks everyone for the attention, and looking forward to more discussion.